Good morning. For Traders Exclusive, this is George Tkaczuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. What I'd like to do is talk about the equity markets this morning, and the equity markets, the uptrend continues. Since the Christmas Eve day low, markets continue to trend higher and they're acting quite strong. Now, 2 weeks ago we talked about how the equities were probably pulling a little bit right as they get to their 200-day moving average. I was right at about 2730 on the S&P 500. And a little bit below 7,500 on NASDAQ. And that's exactly what happened last week as the NASDAQ pulled back the last few days as the S&P did and the Dow, but very orderly. What I mean by that is the selling's been quite tame. Not at all like the selling we've seen in early November or early December when the indexes broke through the 200-day lines, just reverse, capitulate, really crashed through the 20-day moving averages, and that was like really bad. But now they continue to hold up, so that's a very good sign. The other things I want to talk about is we talked about how the software industry groups were acting very strong, and that continues to be the case. But also, we're in earnings seasons now, and the most important thing is to see how the market reacts to the earnings. It's not so much what the earnings actually are or what the CEO says on the conference call, but it's what the market says about the earnings. And here's what I'm referring to. For instance, for example, now these aren't trade recommendations. Some of these trades we did take, this is just an example of what you can see. So ServiceNow, symbol NOW, gapped up on earnings about 13%. And your question is this buying or is this a liquidity event that institutions will sell into? Well, 2 days later, or actually the next day later, it's holding that level at about 220. Then it continues to track higher. That tells you can go in there and nibble on that stock because they're holding that high volume close and continues to move higher. Similarly, you can get a reversal down to the downside. Take a look at a stock like Electronics Arts, symbol EA. Crashed after earnings, looks terrible. It's down about 15% or so. You say, oh, that's the end of the world. However, the next day it held at close and then continued to trade higher. It was trading about $80 3-4 days ago, and now it's trading over $100. So it's the reaction that the market has, no matter what the initial reaction is, what the follow-up reaction is. Similar we saw on World Wrestling Entertainment, symbol WWE. Right after earnings, market ticked up a little, crashed down about 8% or so, however, turned around at the end of the day. And again, you don't know is that good or bad. However, you see in the subsequent days, as the market trades, holds those levels and trades up higher, that tells you there was buying coming in, they shake the people out, and that's what goes on during this earnings season. So, we always talk about let price and volume be your guide because price is the only thing that pays. Rhetoric doesn't pay. So you want to take a look at what the market says about an earnings reaction and continue to look at those stocks who a day or two after their earnings firm up or continue to break down. But the market will tell you which way you need to go. So as always, let price and volume be your guide. This is George Tkaczuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Have a great trading week and watch those earnings.